morning to everyone. Today we are going to see about the case study video in the functional accounting. Let me discuss about that.
I'm going to explain about accounting from not-for-profit organizations. So these are organizations that don't exist to earn profit but to serve society. Examples, schools, education, charity, hospitals, etc. Its main objective is to not to make profit but to serve for society. And its key features is no owners or shareholders. Income is used for social and service process, and profit is called surplus and deficit. So in this decision, they used to calculate three accounts, which is a receipt and payment account, and income and expenditure account, and balance sheet. In receipt and payment account, they used to calculate which is receipt and which is payment, and they used to calculate profit or loss in this account. And in income and expenditure account, they used to calculate surplus of income. And in balance sheet, they used to balance the contributions.
Next, I am talking about the ROI account. The ROI account is an important concept in accounting. Mainly used when one party allows another to use it asset or right in return for a payment or royalty. These assets can include natural resources like minerals, copyright, patents, trademarking, or even books or music. Royalty is usually paid based on production, sale, or usage. For example, if a company extracts coal from a mine owned by another party, it pays royalty based on the quantity of coal extracted. Similarly, author receives royalty based on the number of books sold. In accounting, the royalty system involves two parties, the lessor and the lessee. The lessee pays royalty to the lessor as per the agreement. Sometimes the agreement also includes a minimum rate, which is least amount payable regardless of actual production or sale. If the actual royalty is less than the minimum rate, the difference is called short royalty.